Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Hit the like button, subscribe if you haven't. And I just want to do a quick video today to look into the gold bull market and see from the 2015 onward, even though it didn't feel like one, and just explain why it happened and build on my past lessons of why it needs many years to start going at a multi-year constant upswing. So let's get started. In November of 2015, that was the end of the bear market from 2011 to 2015, and the bottom was roughly 1067. I remember that time, everyone thought for sure it was going to go in the triple digits and it never did. It never went into the 900 area. So the first swing was November 2015 to August of 2016, where it went from 1,067 to 1,330. And that was not really a too bad quick run for numerous reasons. One is the Fed was tapering, then it ended QE, and everyone was celebrating. And while it was tapering, it was pricing in numerous, and I mean numerous rate hikes, 4 to 5 a year, autopilot. And when it ended, they started pricing out future rate hikes, and that's why gold made a quick rally. Even Janet Yellen said, as Fed, that we'll never be in recession again. So that's why it didn't last long. Had a lot of good positive developments, not developments, but the market was looking at everything positively. And so there was no really need for gold, but they priced out some future rate hikes because the Fed was doing slower. The Fed was talking about 3 to 5 rate hikes each year until it was normalized. So shortly after that, it went in from 2016 till July of 2018, a very long grinding consolidation. And in July of 2018, it hit a low of 1176, so 1176, and the top was in July of 2020, 2036, hit a new all-time high. I don't know if that's the exact all-time high, but that had a couple of really fundamental developments that happened. In 2019, they eventually stopped breaking hiking rates, and in 2019 they lowered them 3 times. And then in 2020, COVID hit and the stimulus, and they took rates just down to zero and started doing QE. So that really jumped gold up a lot over the course of about 18 months, 19 months roughly. And what ended it is inflation started ratcheting up, and Yellen that was around her famous transitory comment. And so high inflation numbers and markets being forward-looking thought this all would come to an end, and they're eventually going to stop doing QE, and everything's going to open up. And you talk about a wrong prediction. Not everything opened up per se, but also but inflation just being transitory, that it will slowly go away over the next couple of years. So that once she made that comment, gold had to be in a consolidation for a while, and then as inflation keeps going up and up and up, or at least sideways, then it would eventually, sentiment would start picking up. But in August 2021 through February 2022, there was a run up from 1728 to 1900, and that was, I think, the geopolitics solely. They weren't really, it wasn't monetary stimulus, fiscal stimulus, bad economy. And so a lot of people were worried about it. But the war, even though it's ongoing, started becoming an afterthought. They thought this would just be they were saying Ukraine was winning. And then the Fed in February, because the high inflation numbers said we're going to start jacking up rates. And they've went through a long rate cycle. But recently, gold hit a low in February 2022 around 1651, and it started going up. And I think one of the reasons is in the beginning, if you listen to this channel in 2022, I was talking about recession and 2 negative quarters GDP, which I was right. We were going to have 2 negative quarters of GDP. But that started, talks of recession now are starting to occur. People, Wells Fargo even came out. They think a recession's coming next year in 2024. And not only that, 3 banks failed. So the market's now trying to sniff out when the Fed's going to stop hiking or reverse. And not only that, I think one of the reasons the banks failing has gotten people thinking we can't do any more Fed rate hiking. So real rates will start to decline and become negative. So I just wanted to go over those couple of things about going back to my videos. Needed poor economic numbers. For the most part, up until now, never had that. Needed monetary stimulus. Some had it, but they didn't have the poor economic numbers, or at least they couldn't be priced into a potential long term. And there needed to be not just poor economic numbers, but geopolitics and declining real rates. And all of them have to occur. And if you can see the last run-ups, not all of them were occurring at once. And that's why they were just cyclical bull markets and not a secular long-term bull. And that was the whole point I wanted to go, is that this one seems more sustainable now because you have banks failing, you have bad economic numbers, you have the markets trying to have declining real rates, among other things. And the last 3 run-ups from 2015, they were just singular reasons, and that's why they didn't last too long. And the one that lasted the longest, July 2018 to July 2020, that had multiple reasons: lowering rates, higher inflation, and if it wasn't for Janet Yellen's transitory comment, I think it would have began a secular bull market. But the August 2021 through February 2022, just geopolitics. So anyway, that's my thoughts. I just wanted to go over all those and conclude another point. I'm going to do another video soon. I hope you like this video. Hit that like button, subscribe.